If you have a little idea about Forex, then you must have heard that you can start your Forex trading from as low as $10. Or you may have seen people making thousands of dollars from the account as low as $50. So, how is it possible? With such a small account, you cannot even open a trade with one micro lot. Then, how is it possible? Well, leverage is the key to that. And in this video, I will tell you what is leverage. Leverage is nothing but the money which a trader borrows from the broker to increase the profit potential. Let us try to understand this with the help of an example. Let us consider you funded your trading account with $1,000 and your broker provides you no leverage. So you have to trade with the leverage of 1:1. This means that with a $1,000 account, you can buy or sell only 1,000 units of any currency pair and you cannot borrow any money this time. Now, let's say you bought 1,000 units in USD JPY. That means you used one micro lot size, that is 0.01. Let's consider you bought this 1,000 units for 110.000 and then the price moved to 111.000. This means that the price moved 100 pips and you had a profit of $10, as with one micro lot size, 1 pip is equal to 10 cents. Now let us consider you had a leverage of 1:10. This means that your broker allows you to use 10 times more money which you have in your account. And your broker lets you control $10,000 with your $1,000 account. So this time you can buy 10,000 units in USD JPY or use one mini lot size with the same account of $1,000. Let's consider you bought 10,000 units of USD JPY at the price of 111.000 and the price moved to 111.000. This means that the price moved 100 pips and you had a profit of $100, as with one mini lot size, 1 pip is equal to 10 cents. So in simple terms, leverage means borrowing from your broker. That means if you have a $1,000 account and a leverage of 1:10, then you can buy or sell 10,000 units or control $10,000 from your account. And if you have a $1,000 account and your leverage is 1:100, then you can buy or sell 100,000 units or control 100 times more money than your account or use one standard lot size. Now, there must be one question that might be coming in your mind. Why does the broker let you borrow money? Well, there is a really simple and straightforward answer to that. Your broker earns money when you trade more, and therefore your broker wants you to trade more. Also, the broker keeps your initial deposit aside, and as soon as all your trades are in loss and are reaching the initial account balance, then the broker will not let the account go in negative and close all your trades. For example, let us say you have an account of $1,000 with a leverage of 1:100. Let us suppose you decided to open a buy trade with one standard lot size at the price of 111.000 and the price then moved to 110.000. This means you had a loss of 100 pips, and with one standard lot size, 100 pips are equal to $1,000. Now, as your account was in a loss of $1,000, your account will get flushed or you will lose $1,000. So you can clearly see that leverage is a double-edged sword, which means that it can help you make good profits, but it may also make you lose your account in a single trade. So trader needs to choose leverage perfectly. But the question is, what is the perfect leverage? Well, all the professional traders use leverage ranging from 1:10 to 1:50. But that is also because of the big account size. If you have an account size ranging from $50 to $5,000, then you can go for the leverage of 1:100. And if you have an account size greater than $5,000, then you can choose a leverage of 1:50. Just make sure you don't risk more than 3 to 5% on your single trade. I hope you have understood what is leverage. This is a little complex topic, so if you have any doubt, feel free to ask me. Thank you. Hello and welcome to this video. In this video, I will tell you what is margin. Now, leverage is directly related to margin. And as in the previous video, we learned about leverage. Let us take a small recap about leverage and then we will move on to margin. So, if you can recall, leverage is the money that a trader borrows from the broker to increase the profit potential. Now, there are different types of leverage like 1:10, 1:50, 1:100 and even more. And what this means is with a leverage of 1:10, you can control 10 times your account, and with 1:100, you can control 100 times the amount in your account. Now, let us say I have deposited $1,000 in my account and the account leverage is 1:100. So this means that I can control $100,000 from that $1,000 account and the total margin of my account will be $1,000. But now the margin used will depend upon the percentage of account I am using. For example, if with that $1,000 account I place a trade with one standard lot size, then my margin will be $1,000 as I am using 100% of my account. So the simple definition of margin is the margin is a good faith deposit that a trader gives to the broker to initiate a trade. Now, let us say you have deposited $2,000 in the account and the account leverage is 1:100. So this means that you can control $200,000 from that $2,000 account and the total margin of the account will be $2,000. Now let us say you decided to buy 100,000 units with your account, which means that you are using only 50% of your account in one trade. So now the broker will set aside $1,000 from your trading account or 50% amount of your account as a good faith deposit. Like in this example, I have account of $1,000 and leverage on this account is 1:100. So as I open a trade with one standard lot size, you can see the margin is $1,000. Now this time let's buy only 10,000 units or use one mini lot size. So you can clearly see that when I place a trade with one mini lot size, the margin is now $100 or 10% of my account. Now with these examples, it might be clear to you that margin is a safe deposit that your broker set aside as you place your trade. So that's all for this video. Thank you. Hello and welcome to this video. In this video, I will tell you about a few things which you should know in the Forex chart. So this is tradingview.com where I do all my technical analysis. I use TradingView because it is very easy to use and has a very user-friendly interface with lots of tools and indicators. Now, this is how a Forex chart looks. There are different types of charts available like bars, candlesticks, line charts, etc. When you use a line chart, whatever the movement going on in the market is represented by a line. When the line moves up, it means that the price is moving up or the price is rising. And when the line moves down, it means that the price is moving down or falling. In the same way, when you use a candlesticks chart, the candlesticks show the price movement in the market. Candlesticks are the most preferred chart type for technical analysis. So let us learn about it. A candlestick consists of two main parts, the body and the wick or shadow. This area over here is called the body and represent the opening price and the closing price of the candle. The wick represents the highest or the lowest point to which the price has moved. Like here in this candlestick, the body of the candlestick started from 0.10136 and ended at 0.09441. This means that the opening price of the candle is 0.01136 and the closing price is 0.09441. Here you can also see the wicks candles have created. This tells us the highest price and the lowest price of the candle before it was completed. Now, if you have the chart on a daily setting, each candle represents one day, with the opening price being the first price traded for the day and the close price being the last price traded for the day. In the same way, if we move to a 4-hour chart, one candle will take 4 hours to complete, and if we move to 1-hour chart, one candle will take 1 hour to complete. Now, many of you may be wondering, why are there different colors to my candlesticks? Like some are white and some are black. Well, there are two types of candlesticks: bullish candlesticks and the bearish candlestick. The candlestick which moves up is called the bullish candlestick, or when the price moves up, it is called a bullish price movement. When the price moves down, it is called bearish candlesticks, and the price movement is called a bearish price movement. Now, you can set the color of the candlesticks as per your need. In my chart, the white candlesticks represent the bullish price movement and the black candle represents the bearish price movement. Now, moving forward, there are three different types of markets: uptrending market or bullish market, downtrending market or bearish market, and the ranging market. When the price keeps moving up continuously for a few days, it is called an uptrending market or bullish market. When the price keeps moving down for a few days, it is called a downtrending or bearish market. And when the price moves sideways, it is called a ranging market. Like here, you can see that the price was continuously moving up. So this was an uptrending or bullish market. Now here the price was moving sideways, hence ranging market, and here the price was moving down, hence a downtrending or bearish market. So these were a few basic things which you should know about in a forex chart. Thank you. To buy and sell currencies in the forex market, you need a broker who allows you to trade, and then you need a trading platform from where you can directly place your trading orders. There are a lot of trading platforms available in the market from where you can buy and sell currency pairs. Out of all, MetaTrader is the most widely used and easy to use trading platform. MetaTrader comes in two variants, MT4 and MT5. Both of them are similar to each other, it's just that MT5 is an upgraded version of MT4. Both are available on desktop, smartphone and web versions. In this video, I will give you a short overview of this platform and will make you familiar with it. Okay, so this is the MetaTrader 5 trading platform. MT4 and MT5 are almost similar in the interface. So if you are using MetaTrader 4, the things which I will tell you in this video will be the same for the MT4 trading platform as well. This is the market watchlist section where you can view charts of different currency pairs. You can also add more currency pairs to this section by clicking on the plus sign and then searching for the currency pair you want to add. Now, if you wish to bring any of the currency pairs to the window section, just right click on the pair which you want to add, then select the chart window. The window will be added over here. You can shift between different charts from here itself like this. If you want all the charts together on one screen, just double click here. Moving forward, you can change between the line charts, bar charts or candlestick charts from this section. From here, you can zoom in and zoom out of the chart with ease. Now, as there are different time frames, you can change the time frame of the chart too. Just right click, go to the time frames and select whichever time frame you want. This is the trade section where you can see your ongoing trades, your balance as well as the history of your previous trades. Now let us see how to open and close a trade. To open a trade, you will see a box here. You can open a buy or sell trade from here itself. Just enter the lot size here and click on buy or sell option. For many of you, this box may not be available. For them, just right click on the chart and click on the one click trading option. After you open a trade, if you wish to close it, you can directly do it from the trade section. Just click on the cross button. Now, there are various other ways by which you can open trade, like limit orders. MetaTrader also offers various tools for technical analysis, which is available here on the toolbar. This is the crosshair by which you can find different levels. You can also calculate pips using this tool. For that, select the tool, left click and hold on the point from where you want to start measuring the pips and then drag it. There are various other tools in this box like vertical line, horizontal line, trend line, etc. And if you wish to add more tools, you can go to Insert, select Objects and then choose whichever tool you want to use. Now let us see how to add indicators to your chart. MetaTrader provides you a variety of indicators. To add an indicator to your chart, go to Insert, select Indicators. Now here, there will be a variety of indicators. Choose whichever indicator you want to add and then click on it. A box will pop up, adjust the settings according to your needs and then click on OK. The indicator will be added to your chart. If you wish to remove the indicator, right click on the chart, go to the indicator list and here you can select the indicator which you want to edit or delete. So these are the things that you will need to understand to get started with MetaTrader 5 desktop version. Now let us go to MT5 smartphone version. MetaTrader 5 is a mobile trading platform that allows you to trade on the go. So this is the MetaTrader 5 iOS version. On the screen, you can see the quotes option to the bottom left. This is the market watchlist section. Here you will find different currency pairs like Euro USD, USD JPY, etc. Now if you need, you can add other currency pairs too. For that, go to the search option to the top. Then you can choose whichever pair you want to add and it will be added to your watchlist section. Now to go to any of the chart windows, just touch on the currency pair and go to the chart. Now to the top left, you have the time frame section by which you can change the time frame of the chart. In the trade option, you can see your account balance, margin, equity and also the ongoing positions. To the right, you have a plus sign. From here, you can open a buy or sell order as well as set take profit and stop loss. Now, just like the desktop version, you can use the indicator on a smartphone app as well. To add indicators to your chart, touch on the F icon on the top. Here you can add an indicator to the main window as well as the indicator window. If you want to add an indicator that is plotted on the chart or let's say candlesticks, you can add it in the main window. And if you want to add an indicator which follows the price like RSI, then you will have to add that on the indicator window. Also, if you want to add an object, you can also do that by clicking on the object option on the top of the screen. Now, if you want to change the background of the chart or the types of the chart, double tap anywhere on the screen and go to settings. From here, you can change the chart types. In the colors section, you can change the colors of the candles as well as the background. Finally, to add a broker or to log in into your account, go to settings, click on a new account and search for your broker. So these are the things that will help you get started with MetaTrader 4, MetaTrader 5 and Forex trading if you are a complete beginner. Thank you. Forex traders use a variety of strategies and techniques to determine the best entry and exit points and timing to buy and sell currencies. Market analysts and traders are constantly innovating and improving upon strategies to devise new analytical methods for understanding the currency market. If you were to find out the total number of trading strategies or types, there are a lot of them. Every other trader out there uses a different kind of strategy, but all the strategies fall under three types of analysis: technical analysis, fundamental analysis, and sentimental analysis. In this video, we will learn about different types of analysis in Forex trading. Number one is technical analysis. Technical analysis is one of the most widely used types of analysis in the Forex market. In technical analysis, the traders study the price movement. There is a very old saying which some of you must have heard. The saying is, history tends to repeat itself. In technical analysis, a person can look at historical price movements and determine the current trading conditions and potential price movement. Traders believe that all the current, previous, and the future market information is hidden inside the charts, and technical analysis is a way to decode that hidden information. The person who uses technical analysis to trade is called a technical trader. Now, there are different types of strategies under this kind of analysis, and there are different tools and indicators which technical traders use. Number two is fundamental analysis. Every country has different economic news scheduled throughout the day, and this news directly reflects the condition of the economy of the country. As I told you earlier in this class, that the economy of the country directly affects the price of the currency and the currency pair. So, if the country's economy is weak, the currency will be weak. And if a country's economy is strong, then the currency will be strong. For example, let us say you are trading on USD JPY. You did your fundamental analysis and got to know that USD is going to get stronger and JPY is going to get weak. So, what you will do is open a buy trade on USD JPY, that is, you will buy US dollars. So, many traders use the news to do the complete analysis and predict if the economy of a country is going to go up or get strong or weak. So, many traders use the news to do the complete analysis and predict if the economy of a country is going to get strong or weak. And based on this, they predict the future price movement in the Forex market. The traders who use fundamental analysis to place a trade are called as fundamental traders. Third is sentimental analysis. There are millions of traders out there in the Forex market, and every trader has its own belief and bias. Like at some point in the market, there are traders who buy, and at the same point, there are traders who sell. The outcome of where the price will move depends upon the number of buyers and sellers present in any market. Like at some point, if the buyers are more than the sellers, then price will move up. And if at some point the sellers are more than the buyers, then the price will move down. In the sentimental analysis, the traders look for the data of what other traders feel about a particular currency pair, and then look out for what is the bias of most of the traders. If the buyers are more, then they look for a buying opportunity, and if sellers are more, then they look for a selling opportunity. The traders who use sentimental analysis is called as sentimental traders. Types of analysis is a very vast topic and involve a lot of other things. I tried my level best to give you a proper understanding of this. So I hope you have understood everything correctly. If not, then feel free to ask me in the comment section or the discussion. Thank you. Now that you have come this far and almost completed this class, you have all the knowledge you need for getting started with Forex. And the next thing for you to do is just look out for a Forex trading strategy and give it a try. Also, I have classes on different strategies ready for you all. But before you go and just randomly select a strategy, there is one really important thing which you should know and do it right. This thing is so much important that even now I feel that if somehow someone would have told me this when I first started my Forex trading, I wouldn't have wasted my first few years of Forex trading journey. So the important thing which I am talking about is to select the perfect trading style. I know it doesn't really seem that important, but trust me, it is very important. Let me ask you a question. What if a horse decides to plow on a farm and a bull decides to run in the race of horses? Well, that won't work out and the results won't be great either. That is what happened to me in my early trading days. At the very beginning of my Forex trading career, when I first started or when I first came across Forex trading, I had no idea about Forex. I just bought a course which promised me to earn a lot of money from Forex, and the course was about scalping. So I started implementing the strategy, but even after working hard, I lost a huge amount of money with that strategy. And I had no idea why. I was not even aware that there are different styles in Forex trading. As days passed, I liked the concept of earning money from a laptop and started pursuing Forex. So I researched and then bought different strategies from other successful traders. That was the time when I got to know that there are different trading styles in Forex. And then I realized I was a horse who used to plow on a farm, or I was a bull who was running in the race of horses. I realized that I am doing one big mistake from the starting of my Forex trading career. And that mistake was choosing the wrong trading style. It was like I was a horse which was made to race, but instead of that, I chose to plow on a farm. I wasn't doing what I was made for. This exact same thing has happened with a lot of Forex traders out there. Even some of my students have gone through this. I don't want you all to move in the wrong direction like the rest of the beginners. So just stay with me, as in this video I will explain to you what are the different types of trading styles and how to choose the perfect trading style for yourself. Now, there are different types of doctors like general practitioners, neurologists, surgeons, etc. And then there are different ways to become a doctor based on its type. And each one has its own purpose. In the same way, there are different trading styles for each one of us. There are four main types of Forex trading styles: scalping, day trading, swing trading, and position trading. Scalping is a very aggressive trading style, and there are a lot of risk involved in it. But then it has got great rewards too. Scalping is a trading style in which traders use 1 minute to 15 minutes time frame to place a trade and profit from very small or minimum price movements. Scalper makes trades on smaller time frames and get out within seconds or minutes. In day trading, traders buy and sell currencies within the same day. That is, traders open and close their trade in a single day and no trade is held overnight. Day trading is a trading style in which the traders use 30 minutes to a 4-hour time frame to open a position and profit from medium price movements throughout the day. Now, talking about swing trading is a type of trading style in which the trader opens a position and keeps it running for days or weeks until its trade potential is reached. Swing traders mostly use 4-hour or higher time frames to place a trade. And then position trading is the type of trading style in which traders open a position and keeps it running for weeks, months, or even years. Position trading is the same as that of investing. You need to do it for a long term and be patient for your trade to work out. In position trading, you have to identify the long-term trends based on fundamentals of the currency involved in a currency pair. So these are the four different types of trading styles. Now, many of you must be thinking, which one is the better trading styles? There is no such thing that a particular trading style is better than the other. Every trading style has a different purpose and each one is suitable for different people with different personalities and other few things. So instead of searching for a trading style which is best, it is important to know which trading style suits you the most. Like scalping is best for traders who can spend more time on charts. and can make quick and difficult decisions without hesitating. Scalping also requires a lot of focus and concentration. So, if you have what it requires, you can be a scalper. Furthermore, you get a lot of setups while scalping. So, if you are one of those impatient traders, then go for scalping. Now, day trading is for those who can spend the whole day on charts. It is just like a full time job. You will have to analyze the chart at the beginning of the day and monitor it throughout the day, just like you do any other 9 to 5 job. In this, you will get a fewer setup as compared to scalping and will have to be patient. So, if you are okay with getting a few setups and spending a whole day on trading, then you can choose day trading. People who have a full-time job and can only do the analysis on weekends and keep a check on during the weekdays can easily do swing trading or position trading, as it is less time consuming. So if you have a part-time job, then you can easily choose a swing and position based trading style. But you may require a large initial amount to start with if you choose position trading. Finally, if you are patient enough to wait for trades and have long-term goals, then you should choose swing-based trading or position-based trading. Now, which trading style is the best for you, or which forex style should you choose? When choosing a trading style to suit your needs, here are some questions which you should ask yourself. Like, question number 1 is, am I short-term or long-term oriented person? If you are short-term oriented, then scalping or day trading can be good for you. And if you are long-term oriented, then day trading, swing trading, or position trading will suit you the most. The second question is, how much time do I have during the day to trade? If you have the whole day, then go for day trading. If you have 5 to 6 hours, then go for scalping. And if you can only check up on your trades, then go for swing trading or position trading. The third question is, do I work full time? If you have a 9 to 5 job, then go for swing trading or position based trading. If you work part time, go for scalping. And if you don't work at all, then day trading will be the best for you. The next and the last question is, am I patient enough, or do I need to see results quickly? If you are patient enough, swing trading or position trading style is the right for you. Trust me, swing trading seems to be dull and very slow trading style. But when done right, it does wonders. But again, it should suit you. Now, if you want quick results, scalping or day trading is the most suitable one for you. So, these were a few questions which I think you need to answer before you choose a trading style. After you are done with selecting a perfect trading style for yourself, the next step is to find a forex strategy of that particular style. If you go out in the market looking for forex trading strategies, you will find a lot of them. Everyone out there is trying to sell a forex trading strategy that comes with some unrealistic promises of making huge money. Some of them even claim to have a holy grail strategy that doesn't fail. But it doesn't work like that. Most of them are just trying to make money by selling strategies. Not every strategy works. There are only a handful of strategies that will help you make money in the market. There are certain criteria that a good forex trading strategy should fulfill. And I call this a blueprint for selecting the best forex trading strategies. The first criteria is the risk to reward. I don't know why, but I have noticed the majority of traders only talk about the win rate. Even if you go out to buy a strategy, you will notice that most of them are selling a forex trading strategy based on win rate itself. I don't say win rate is not important, but the problem is the win rate doesn't even tell you 20% about the strategy. If I was to choose between a strategy with 80% win rate and no fixed risk to reward and a strategy with 50% win rate and 1:4 risk to reward, I would choose the strategy with 50% win rate and 1:4 risk to reward. Consider you have a trading strategy with 80% win rate but no fixed risk to reward. Now, what happens in this case is Even if you win 80% of your trades and make a decent amount of money, the 20% trades which you will lose can blow up your account and make you lose your money, as the strategy doesn't have a proper risk to reward ratio. The trading strategy should always have a high or decent amount of risk to reward ratio. If the risk to reward is low, then you should at least know how much you are risking and what is the reward. The second criteria is the risk management plan. This is the most important thing for any forex trader. I have been trading for more than 8 years now, and I haven't seen a single forex trader who is making money in forex and is not good with risk management. Every professional trader out there excellently manages risk, and that's what makes them successful. So it is very important to choose a strategy that has its very own risk management plan. The third criteria is multiple setups. Many professional traders don't rely on single setups for placing a trade. We have different structures in the strategy and we use it accordingly. Waiting for a single kind of setup can be too dull and can make you lose your patience and make you do things which you should not be doing. For example, if your strategy has only one kind of setup, then your mind will make you enter a trade too early without even the setup being confirmed. And this can be very bad for your account. So always choose a strategy which has multiple setups included in it. Now the fourth criteria is indicators. Indicators ain't loyal. A strategy should not be totally dependent upon indicator. I'm telling you this from the experience I have. I'm not saying indicators are useless or they do not work. It does work, but then it needs some extra confirmation. If you're trading with a strategy that makes you enter a trade based on the indicator itself, then you are in big trouble. You need to understand this. Humans make indicators and they are just there to improve your trading. It isn't a holy grail technique that will ensure you a 100% win rate. So while choosing a strategy, always make sure that the strategy is not totally based on indicators. The fifth criteria is trade management plan. Every strategy has a trade management plan, which tells us when to get out of a trade or when to enter a trade. A trade management plan helps you to manage your trades properly and works as a navigation system for you. It guides you with different trading scenarios and helps you face them with ease. So the strategy you choose must have a proper trade management plan included. So these are the important criteria which you should consider while choosing a forex trading strategy. Hello and welcome to this video. In this video, I will tell you how to choose a proper broker. There are a lot of brokers out there. Everyone has something to offer for their clients. But before you open an account in any of the available brokers, there are few things which you should look after before opening an account. Number one is the broker regulated? Now, imagine you made $1 million by trading Forex, but when you tried to withdraw your funds, the broker didn't give you the withdrawal. This is one of the most common problems. Many brokers will offer you low spreads, no commissions, bonus, etc. to attract you. And when you try to withdraw, they won't allow you. This happens when you choose a broker that is not regulated. A broker that you choose should be regulated under the governing body of the respective country. Now, each country has its own governing body that looks after the brokers and make sure they follow strict rules and don't scam people. Number two is the type of trading style you are using. It is very important to choose a broker that suits your trading style. Now, some brokers offer you commission-based accounts with low spreads, and some broker offers zero commissions account with a little larger spreads. Now, if you are a scalper or day trader, then you will need low spreads. So you should choose a broker who provides you with low spreads. And if you are a swing trader or position trader, then the spread doesn't matter to you. So in this case, you should choose a zero commission broker. So before you choose a broker, make sure you keep this thing in mind. Number third is trading platforms. The next thing which you have to look after is the trading platform. The trading platform is the most important tool for any forex trader. So while choosing a broker, make sure you get to use the trading platform of your choice. Number fourth is currency pairs offered. There are different types of currency pairs like major, minor and exotic. Plus, you can also trade metals in the forex market. So the broker must provide you with all the major, minor and exotic currency pairs. Number fifth is ease of money transfer. Different brokers have different deposits and withdrawal options. So only choose a broker who allows you to withdraw and deposit money with your choice of medium. Now, number six is initial deposit. Many of you may be beginners in forex trading, and a beginner should always start live accounts from small amounts at first and then increase when they are confident enough. So make sure you choose a broker such that they offer small initial deposits for opening a real account. The small initial deposit may range anywhere in between $10 to $100. So these were the few things that you should look for while choosing a broker. Thank you. In the previous video, we learned how to choose the best broker as per your trading style, needs, and other factors. Now, before I tell you how to open a demo account, I want to talk about a really serious issue associated with using demo accounts. It is kind of a mistake that many beginner forex traders make, and I don't want you all to make the same mistakes. The mistake is that they don't treat the demo account as they would treat their live accounts. It is really important to treat the demo account as real ones because we are testing a strategy in it and we need to be honest with ourselves to see if the strategy works or not. But what most of the traders do is they don't treat a demo account as real one. They use account sizes larger than they would use on the live accounts. They use more leverage in demo accounts than they would use in the real ones. And the biggest mistake is that they spend too much time on demo accounts. Look, the main job of the demo account is to help you test if your strategy works or not. So if you do not treat the demo account as live one, then you will mess up in the live accounts. Also, the live trading is way different than that of demo trading. It includes the hardest part, which is emotions. So if you just keep spending much time on your demo accounts, you won't be able to master your emotions and suck in live trading. So you need to treat your demo account as you would treat your live accounts. There are a few things that you need to consider while opening a demo trading account. Number one is deposit amount. Choose the same deposit amount which you are planning to start your live account with. Like if you wish to start your live account with $500, then open a demo account with $500 itself. Number two is leverage. If you are planning to start with a live account of $500, then the leverage you would use is 1:100. So in the demo account, you should choose the same leverage, which is 1:100. And if you are planning to start live account with $10,000, then you will need to use the leverage of 1:10 or 1:50. So while you choose the leverage for demo account, make sure you choose the leverage which you are going to use on your live accounts. Number three is time. Do not spend much time on demo accounts. If you are into day trading or scalping, then you should spend a maximum of 2 weeks practicing on a demo account. If you are into swing trading or position trading, then you can practice on demo accounts for a couple of months. These are very little things that make a huge difference in your trading journey. So make sure that you take a note of this and see you in the next video. After you are done with selecting a trading style, a trading strategy, and choosing a broker, you need to first test that strategy on a demo account to get used to with that strategy. So in this video, I will tell you how to open a demo trading account. After selecting a broker, go to the website of the broker you want to open a demo account on. For example, I want to open a demo account on IC Markets. So this is the website of IC Markets. Now, when you go on the website, you will find an option for opening a demo account. Like here, you can see the option of try a free demo account. So all you have to do is click on that. Now on the next page, they will ask you for all your personal details. Fill up the details and click on the register button. On the next page, they will ask you for the trading platform and other details. Choose a trading platform which you want to use. If you use MT4, then choose MT4, and if you want to use MT5, then choose MT5. Now keep the account type to standard. Now here you can choose the base currency as per your preference. In the leverage section, make sure you keep the same leverage that you are going to use in the live account. Like I use the leverage of 1:10, so I am keeping the leverage to 1:10. Now keep the initial deposit the same as you would use in the real account. I will use a live trading account of $10,000, so I will deposit $10,000 in my demo account. And now click on proceed. After you are done with it, you will receive user ID and password on your registered email address. After you are done with opening a demo account, go to the MetaTrader 4 platform. So here you can use any of the two versions, smartphone or laptop. First, we will look for the laptop versions. Open MT4 or MT5, go to the file and choose to log in to a trade account. Enter your login ID and password and select your server. You will get the server name in the email in which you received the ID and password. Now click on OK and you will be logged in into your account. Now if you wish to log in with your smartphone, go to the MT4 or MT5 trading app, go to settings. Now select a new account, search for brokers, enter server ID password, and then you will be logged into your account. So that is how you open a demo trading account.